Hey everybody, welcome back to the channel. So this is going to be a long one today, but it is packed full of incredible information. Got an interview today with Lior Gantz. He's the founder of wealthresearchgroup.com. In today's video, we're going to discuss certain topics. Those topics include the recent market pullback and his thoughts on what caused it, and those catalysts for us stackers and investors in precious metals to look out for going forward. We'll also talk about real interest rates and the dollar index. We're going to talk about a gold and silver allocation and how he kind of manages his $1 million stack, as well as picking winning stocks when it comes to the precious metals mining and royalty sector. That and a whole lot more. I do have this entire video broken up into chapters, so you can skip to any part of the video that you want to see. Thanks for tuning in. Let's get started. I think you're going to love this one, guys. Hey everybody, welcome back to the channel. So today I've got a special guest on the channel. This gentleman here is Lior Gantz, and he's the founder of Wealth Research Group. And I've got a series of questions that I want to ask him because he's a stacker, he's a big-time stacker, and as well as an investor in precious metals-focused businesses. So hey, welcome to the chat, Lior. Thanks for coming on today.
Yeah, thanks for inviting me.
I really appreciate your time. And so let's go ahead and get started with the question that I think is going to be foremost on a lot of people's minds today, and that's going to be your feedback on the recent pullback in precious metals prices and potentially any catalyst that us investors and stackers in precious metals can look for in the future to be more prepared for these types of events.
Absolutely. So, we all know, and it's very exciting, we've just had the 50-year mark for the Nixon shock, basically August 15th, 1971. Was when, and you can free search this on YouTube. This is really cool. You can listen to the original Nixon lecture. There's the brief version of it. It's like 2-3 minutes where he just talks about the gold stuff. But the whole addressing the nation, it's like 40 minutes. And that's really interesting just to see what he was saying at that time to the nation and, why they took it off the gold. And something that's really interesting is that he said we're temporarily suspending the connection between gold and the US dollar. So it's interesting that that was the angle back then. But anyways, as we do this interview, we're about 1 year after gold hit an all-time high in US dollar terms. It's at an all-time high right now in about 70 other currencies. But with the dollar being so strong, we've seen a pullback from $2,069 at the peak, August 6th last year, to below 1,700 3 times. So we've tested that support level, and now we're at about 1,791 as we do this interview. And people are really baffled by how is gold not at 3,000 or more when everything we hear is inflation. Inflation, in fact, if you look at Google Trends, and you right now hit the word inflation, it's at an all-time high. If you look at companies, there are these great intelligence companies that scan quarterly reports and quarterly earning calls from CEOs at the S&P 500 companies, and inflation talk is up 1,000%. Supply chain is up like 1,500%. So everyone's like, why is this almost borderline hyperinflationary environment with what we've seen with wheat and with lumber and with copper? And why is gold and silver? Why are gold and silver the laggards this year? Why is 2021 a negative year for these two metals? The answer is that gold and silver are not inflation hedges. They do not hedge for inflation. What they hedge for is negative interest rates, and therefore they correlate with the difference or the subtraction between bond yields and CPI numbers. And so CPI numbers is only half of the equation, as you can see. What you want to see is you want to see bond yields that are lower than inflation. Then you get a negative real interest rates, and that makes gold much more relevant because it obviously makes it better alternative than cash. And so what we saw in August of 2020, you saw that acceleration of bond yields plummeting. The 10-year bond was actually at 0.5%. Literally, you would lend money to the U.S. government for 10 years and you get 0.5% back on your capital, with inflation being very high. This sentiment changed when the probability that Biden would win over Trump started to shift in August. When the market started to price in a probable Biden victory, that's when bond yields started to accelerate back. They went from 0.5% to 1.7%. That's a 200% move just from August to February 2021. And that killed the gold bull market. Because when bond yields rise, you're getting into an environment where it's less and less negative. Now, it's still much higher than the 1,200 or the 1,400 or 15. So we're still negative real interest rate right now, but they're not as negative as they were in August 2020. And so if you're looking at that and you're asking yourself, why are gold and silver not doing as well as in between March and August of 2020? Well, March and August of 2020, here's what the world thought. The world thought the printing press is running and there's no stopping it right now. Where the Fed literally said, we're not thinking about deficits, we're not thinking about debts. We need to run this in order to bridge the income gaps that happened. A $5 trillion income gap for all the people that were laid off, etc., lower income people. And so when that vibe was happening in the market, of course, gold and silver would rally. When now the shift started to be, we can't do this forever, right? You can't be in sixth gear forever if you're going to hit a turn, right? You need to decelerate. Then this is what we're seeing. And so this is the environment we're in. And actually, if you look at what is the biggest catalyst for gold ahead, is if the Fed would start talking about taper. And that's very contrarian, but that historically really helps gold. When the Fed talks about tapering and actually raises interest rates for the first time. And I could talk about that, but that's my short answer to you. It's not about the inflation. It's about the correlation between bonds and inflation.
I see. Okay. So that kind of touches on my second question, and namely that was going to be on gold and silver's performance this year in this inflationary environment. And you really did help answer with that question. And I recently published a video questioning whether or not silver was a hedge against inflation, as you often hear on the World Wide Web by reading or watching videos on YouTube. So with negative real interest rates, we're seeing gold is staying pretty strong. However, can you put any emphasis on your thoughts with this year's attempt to squeeze the silver market and how any of this has either worked for or against the precious metal silver?
Okay, so if you go to our website, to wealthresearchgroup.com/squeeze, we created a whole report from A to Z on exactly what happened in January when there was a silver squeeze or an attempted silver squeeze inspired by Reddit and Wall Street Bet, etc., and why it did not work. So it's really comprehensive. So if you care about silver, I would definitely check that free download report out. The gist of it is that silver or any commodity is very hard to impossible to squeeze in 2021. If you look at the 1970s, you've had a situation where two oilmen from Texas, the Hunt brothers, were able to buy a third of the global supply, a third of the physical supply of silver and warehouse it. That's impossible to do today. Impossible. So what was possible back then and got the baby boomers fired up about silver because it went from $1.92 to $50, in less than a decade, that is impossible today. And it's not just due to the way that the COMEX is designed. It's also due to what happened with the Hunt brothers. The Hunt brothers were forced by the government to sell their silver. They literally told them you have to unwind your position, and that's how silver prices started to come down from where they were. And the way that the COMEX is structured right now, it's if you look at it from the inside of it, it's very hard to do. What you actually end up doing, and you saw that in real life, is you end up creating two markets. You end up creating a lot of strain on the bullion dealers, which literally cannot source enough physical metal to meet this demand. And you see the premiums go through the roof. So if you try and actually buy Silver Eagles at the time, you're paying way above spot. And then on the flip side, the COMEX is way lower. So the arbitrage between them is where the profits actually are. I would say what the silver squeeze showed is how separate these two markets are. And also they've showed that these short positions on the COMEX on silver, they're not naked shorts, and they're very concentrated shorts. That's the allegation against them, that 8 institutions do most of the shorting against silver. That's very concentrated. But when you look at this 200 to 1 leverage ratios and all these other problems that the COMEX has with silver, I mean, they're not in silver. They're in everything. Except for zinc and cocoa beans, every major commodity in the world trades way more in phantom supply and demand, right, on the COMEX and futures and in options and in derivatives than there's really that supply. The futures market and the options market are not based on the fact that everyone is going to exercise their right to physical. They're based on the fact that governments like China, they're building entire countries in Africa, and they need to source copper 5 years down the road. So they need to hedge their positions in order to make sure that the market doesn't squeeze them and eliminate a lot of the supply from the market and jacks up the price. And so the mechanism that the futures market is not meant to rig the market or manipulate or suppress it. That's how you abuse a perfectly good system that's meant to actually regulate prices and create good price discovery. It's just that JP Morgan and other entities have abused it. They've now they paid huge sums of money as fines, and they continue to do that. But we've seen in the last while 2 interesting things. One was Basel III actually enacted, and 2, you saw this flash crash like 2 weeks ago. And all of these situations with social media and channels like yours that help to distribute this, it makes it very hard for them to continue doing that. Whereas 10 years ago, this was very easy to do because you had to go to these forums and other types of channels to find this out. Now it's everywhere. You just free search JP Morgan silver manipulation, and you can sit and listen to probably hundreds of hours of research and material about it, and then you can do the same thing with articles. And so I think that that is the gist of it. You literally cannot squeeze silver, even if you get Wall Street bets on it, because the government's going to get on it. That's the first reason you can't. The second is the COMEX is built in a way that you can't buy in massive amounts. The way it's designed, there's limits to what you can do before they force you to stop trading. So that's right. Really interesting. And so, yeah, that's basically the gist of it. I think the good thing is, I think silver can hit 50 an ounce without all of this, all these issues that have to do with trying to squeeze it, etc. It can rise further than it is right now. That's the long short of it.
All right. Well, that's a very thorough explanation. I appreciate that. I felt like personally that it brought a lot of attention to
Good.
Silver, to stacking silver. I saw a huge surge in subscribers and views back in February through around about May timeframe. That's kind of tapered off now as some of those folks that obviously ran into gold and silver that were looking to make a quick buck. And I tried to explain to them that it's a long-term play investing, especially in physical, when you take into account the premiums, because you're essentially paying that up front. Thanks for that. And I'm curious to know, if you don't mind sharing, what catalysts that we might need to see in order for silver to break out of its current rut, stuck in the $20 to $30 range, if you have any thoughts on that.
So first of all, silver, to mine it, it's only $13 or $14 an ounce. And so it's already trading at a very high premium to its cost. And commodities, what they try and do is be as close to what it costs to produce them as possible, because other miners would, other people would say, oh my God, you can make $12 an ounce mining silver. It would take me $14 to produce it, and 26, 27 when I sell it, I can make 100% profit. So it introduces more exploration, more etc. But it's not like vegetables, where if a tomato is now selling at 100% premium, I can open a vegetable shop tomorrow. It takes years and years. And so silver is very interesting because it can stay at these levels without a problem. So that's the downside, is not that high, in my opinion. The risk that silver would go down a lot is not high, because I look at things not only from the reward potential, but from the risk-adjusted reward potential. If something has a 10-bagger potential or 1,000% potential, but it has a 600% downside, then it's not that good, right? So I'm looking for risk-adjusted potential. And I think in silver, the risk of it going down by much is very capped. The reason is we know that the support is at around $22.50 an ounce. And so it's very easy for me to look at that and say, okay, if it breaks below that, I can unwind a lot of what I have and not suffer severe losses. On the flip side, I know that the resistance is around 29.5. So what that tells me is that I can be sort of neutral at this point, wait until the price hits 29.5, because that way I know that the resistance has been breached, and there's a whole range of price discovery with not a lot of sellers in there. Between 29.5 and $36 an ounce, you can see a massive rally. And so the question is, do you want to gamble? Do you want to say, okay, it's right now at 26. I want to gamble that it will reach that 36. And that's one sort of a risk reward potential, because it could easily go down as well. Or you can say, okay, I am forfeiting some of my future gains, some of my potential future gains. I will wait until 29.5, where the technical analysis is about 85% probability that it shoots to about 36, and then I'll pile in. So it just depends on what type of investor and trader you are. If this is about physical, then obviously the answer is very clear. You want to buy it as cheap as possible, right? Because you're trying to stack ounces. So kind of two answers for you. If you're doing it the trading route, if you want to make a capital gain, then I wouldn't even touch the actual physical coins. I would go with something that's backed, like there's a physically backed ETF, for example. But if this is like a long term, this is I am going to buy it and I want to give it to my children one day, or something of that effect, where it's decades and decades, then I don't think you should care if it's a dollar more, dollar less. It's not really where where your focus should be. And also, you should really think whether or not you want to hold silver for that long, or gold. That's a bigger question to kind of think about, because of what we saw with Basel III. That really now makes a difference between gold and silver. Literally, if you go to Wealth Research Group again, /Basel, BASEL, like the city in Switzerland where the central bank of central banks is headquartered, and you read that report, read that report, you'll see why Basel III now changed gold and silver. Now there's a difference. Now it's a whole different type of asset class. They're both precious metals, fine, but they're designated differently. And I think for silver, if you're looking for the catalyst for silver historically, if you plot it and try to see which other asset class it acts most like, it literally acts a lot like oil. So if oil's rallying, silver would rally, and it acts a lot inversely to the dollar. So in other words, if the dollar is strong, then silver is weak and vice versa. Under Trump, you saw the gold-silver ratio hitting a high of 123 to 1. If you look at that day where it did that, you'll see that it was a very strong time for the dollar. And when was silver the lowest, trading on the COMEX for $12 an ounce in March 2020? It was when demand for dollars was at its highest in 10 years, because people were panically selling both stocks and bonds. And when you settle any sort of transaction in bonds or in stocks, what do you sell it at? Well, you sell it in dollars. There was such a demand for dollars, it literally just compressed the price of silver to below where it cost to actually mine it, $12 an ounce. So that was a really good opportunity to actually buy. And so if you look at the biggest catalyst for silver, it's the dollar. And the way you look at that is you look at something called the DXY. That's the index that measures the dollar compared to other competing fiat currencies like the euro, the Swiss, and the Japanese yen. When that index is below 90, that's really good for silver. Very good for silver. Look at that right now. As we're doing this interview, I think it's about 92 or 93.
Yeah,
so
it's been creeping up.
Yeah, it's been creeping up because of the risk-off environment. If you look at August, the Russell 2000, which is basically the small cap index, it's in a correction. It's literally down 10% right now. And so all these people selling their high growth stocks, they settle them in dollars. But if you look at the DXY over time, you can see how precisely how it started to rise in 2011, going all the way to March 2020, a 9-year bull market for the dollar, which is exactly its historical average. It does 9-year bull markets, 9-year bear markets. And so in my opinion, it peaked in March 2020 at 125 to 130 on that index. You can see that. And then it literally has been in free fall. Under 90, it's considered in a bear market. You'll see a lot of algorithms starting to sell it when it hits that 90 level, because they're programmed to sell, because for them it hits, this is a bear market territory. This is exactly what happened with gold, by the way, in that flash crash just 2 weeks ago. Algorithms are programmed to sell it. We can talk about that. But silver, okay, two things. DXY under 90, great for silver. Silver hitting 29.5, double confirmation. For me, I'm going to be very aggressive if both of these things happen. DXY below 90, silver above 29.5. As a trade, I can get really aggressive if those things happen together.
All right, thank you. That's I actually knew pretty much and do talk about the DXY on my channel. I actually talk about the DXY as an impactor against both gold and silver, but from this conversation, I'm beginning to learn that perhaps interest rates have more of an impact on gold, whereas a stronger or weaker dollar has perhaps a stronger impact on silver. Would that be a correct assessment?
Absolutely. So look at the last 50 years. Is that long enough time? Right?
That's a long enough
1971 until today, the gold accelerates at about 6.6% a year, right? From 35 an ounce to 1,800. Silver from $1.92 in 1971 to 25 today. That's about 3.5%. So over time, and you asked me that question, and I know the audience, most channels, the audience loves silver. Because it just when it's on fire, believe me, my heart was pumping as well. 2011, I was sitting there trying to finance my my honeymoon, and you know my position went from like 20 to 42. I was like ecstatic,
Yep.
Because I was going on a 2-week honeymoon, then it became a month, right? So, anyways, I know the exhilaration of it, and I understand that, and everything's fine. But I have to look at facts. The facts tell me that over time, over the long term, gold will probably accumulate better than silver, because gold is strictly a precious metal, whereas silver is an industrial slash or a quasi-industrial, quasi-precious metals, which means that the buyers of silver, they need it for products. And so in their minds is, I need to get it as cheap as possible so I can make a profit on my product, because it goes into phones and 5,000 uses. Whereas gold, people are not saying I need to buy it. I need to buy it as cheap as possible because such and such. No, it's a different mentality. You want to buy it because you're afraid of fiat currencies for the most part. And so to me, silver is more of a, when can I buy it after a big smash and make a profit over a period of time, whereas gold is more of a long term. And if you look at gold and the dollar and you plot them on top of each other, as you say, the dollar can be strong and gold will be strong at the same time. Look at 2018. For example, the dollar was the world's best performing asset class. Best performing asset class of 2018 was the US dollar. The last time that happened was 1969, 2 years before there was so much pressure on. Yes. And so the dollar reached really strong valuations in 2018 with the tariffs and everything that happened. It was a very risk-off event. People were cashing up. 2020, the healthcare crisis. I don't want to get you demonetized. So I'm calling it the healthcare crisis.
Right.
The dollar, same thing. When oil reached that day in April where it hit $42 negative, $42 a barrel.
Right.
In April 20, to me, I literally texted my hedge fund manager. I told him, this right now is the end of the petrodollar. The petrodollar standard is over. There's gonna start to be a new shift. Buy Bitcoin, literally. Whatever you do, move away from the dollar. Look at other currencies right now, because to me that signaled the end. Not to mean that Weimar Republic type of end, but a gradual de-dollarization. And you literally are seeing companies. Tesla announced, we'll accept Bitcoin. We actually want to buy gold. Palantir just bought gold. It's happening. It's happening. So, the answer is the dollar is after a 9-year bull market. I think it's heading into that bear market world, and in that bear market world, it's really good for silver. How much will silver go up is more of a question that nobody can answer. Nobody can know where it's going to peak at. That $50 an ounce has been the peak twice already. So I would suspect there's a lot of sellers at that level. But the amounts that silver is used in most products is so little that if it's $50 an ounce, Apple is not going to complain. This is not going to raise the price of an iPhone or something like that. It can go to $50 an ounce easily in terms of its commercial uses. That's not what's going to dictate its price. The retail buyers, when there's no more retail buyers that are willing to pay $50 an ounce for silver, that's when it's going to start, or whichever price is going to be that psychological price, that's when it's going to start to come down. And so silver stacking is sort of a double standard, because you should really think about silver not from the stacking forever, but from the stacking until it's in a bubble, and then you need to think what to do with it, because it's going to be in a bubble and then it's not going to be in a bubble, and you're going to miss out on that purchasing power. And this doesn't mean that you cannot sell it and move to gold or to other commodities, etc. But you're not betraying the society. You're not betraying the community by selling your silver. This is not the way this goes. This is not a war. that you're fighting. This is buying an asset in order to do something smart with it. And so basically that's the way I look at it. Now, the silver stackers that are thinking, I want to hold this forever because of the fiat currency reset collapse, fine. I do that as well. Here's what I do. Just so I don't antagonize that type of audience, I want to explain that I do that probably more than most of your listeners. I own 24 months worth of my living expenses in physical gold and silver, and I will never sell that. But on top of that, anything I own in the precious metals sector, it's a trade. In other words, if my family burns $5,000 a month, just to give it like a round number, then I take that, multiply by 24, that's $120,000. I convert that from savings in fiat currencies to precious metals. Then I know that if there's a 2-year depression, I've got that huge stack of gold and silver physical. So that I'm not selling ever. But if I look at silver and it goes from 26 to 50 and I've traded it, then yes, that part is trading. That's for capital gains. So I do both. And I don't betray that forever stack that I do own because I fear that central bankers or governments can screw up the system badly, and there's a mass mistrust of the system that can happen, and therefore I have that stash. But on top of that is what I mean. So you can live in both worlds, right? You don't need to live only in the world that hyperinflation is going to come and I need to prepare. You can live in both worlds because as you look at a bell curve, there's a probable likelihood of something, and there's the fringes. So if you want to be protected for the fringes, do that. Have that stash, but also be protected. Also have exposure to the more likely scenario, and that is that the world will continue. We'll find a solution. The human race is very smart, and you should also be in real estate or in stocks, etc., because those have performed amazingly over the last 50 years. And what I hear a lot about, the argument is that, look, if I own Microsoft shares and the dollar goes to zero or hyperinflation and goes to the moon, then my Microsoft shares will be worthless. They won't. They will be worthless denominated in US dollars. But you still own a part of Microsoft or a part of Apple, a part of Amazon, or a part of or a house.
Right.
Your house will also be worth zero or gazillion, but it doesn't mean the house is worthless. You can live in there. You just denominate it in something else. So the only thing that really is worthless is paper money. If whatever that paper money is that you have, that if it goes to zero, then it literally is worth what the paper is worth, right?
So
but
the physical cash.
Yeah, but all the other things, this drawer behind me, if it's worth $0, okay, well, so what? It will be worth like 20 something else, right? Okay, so that's my point. Don't get into that environment where that's your concern, that because it's a paper asset, then because it's not true. A share of a company is not a paper asset. If the fact that it's written on a piece of paper, it's not really a paper asset. You own a piece of everything that Microsoft produces, develops, etc. Hypothetically, if you own Microsoft shares. Okay, so that's kind of where I think about that kind of stuff.
All right, thanks. That was an outstanding answer. And just to let you know, I actually bought 2 shares of Microsoft last week. I buy roundabout 15.
We didn't prearrange this.
No, it was not prearranged. I buy $15 per day of Bitcoin. I have it on an automatic thing. I'm buying $15 per day. I've got a dividend stock portfolio. I see the advantages of being well diversified. Speaking of diversification, and you touched on this, And I understand your theory here on when to go kind of hard on silver on the physical side, as well as if you're wanting to trade. But for a normal physical accumulator, that's the core of my viewers here. Uh, what would you consider to be a good target allocation for someone just getting into gold and silver? How much gold, how much silver? And I'm not really talking on a weight basis here, because obviously they're worth different valuations in dollars by weight, but as a percentage in dollar value, like 60%, 40%, or do you adjust that
Between
based on the
gold and
market?
silver, you mean?
Yes, sir.
Okay.
How much
So
gold, how much silver of the physical kind to hold? Let's say in your example you gave in your 24 months
yeah, mine is
situation,
80/20.
so 80 gold, 20 silver, or
Yes.
and okay, so I can understand that, and for my viewers out there, I think the reasoning behind this is that when you're in that sort of a situation, stability means so much to you, but you might also want to have a portion of that is in a lower denomination, easier to trade. If you ever run into that crazy situation of bartering, which nobody wants to see, obviously, but if it were to ever happen, you would be in a better
And I'm also humble,
position.
right? Could I be wrong? Could
Of
silver
course.
outperform gold for the next 50 years? That's true. So I like that diversification. On the flip side, if you ask me like what do I own more, silver stocks or gold stocks? The answer is, silver, because that's a trade. So like I said, over the long term, if I look 50 years down the road and I say to myself, like, what would I like to give my children? I think that the world in 50 years will appreciate gold as a precious metal more than silver. But I think that silver is much more interesting in terms of the fact that it's such a small market and it could just cook up real fast, and you can make better gains. So if my trading portfolio has way more silver than gold. Now, kind of more importantly, I want to kind of broaden the question, and how much silver and gold should you own at all? So, if I may,
Yes, please. Thank you.
I think what's really interesting is that it depends on your age, in my opinion.
Right.
The younger you are, you should have more allocation towards the stock market, real estate, growth. Look at growth. Growth over time will do you very well. As you're aging, and you're approaching those years where the money that you have invested is now simultaneously the money that you need to start living on, I think you should look less to growth and more to preservation. And preservation means, more precious metals, less stocks, because
Right.
you don't want to be in a position where you need to retire in 2009, and in 2008 your portfolio goes down by 50%.
We see a market crash. Right.
Yes, because a market crash can happen tomorrow. It can happen anytime. So the way you offset this is you diversify out and put it in gold and silver, because gold and silver actually, if you look at it over time, their correlation with the stock market is one of the best in terms of inversing. So it's really it's a true hedge to stocks.
Right.
And so that's really something to think about. Your age, right? If you're younger, maybe less. If you're getting older, a little more. I like my strategy that I box myself and say, look, if there's a 2-year really bad depression, I got all of my needs paid off for in physical precious metal. I like that strategy. But then I grew above it to say, okay, now that 24 months is less than 5% of my portfolio, of my net worth, I'm sorry. And so I don't like that. And so I raised it to 5% of my net worth, if that makes sense.
Yeah, it does.
Okay.
Yep. So most of I wouldn't say most, but a large percentage of the viewers on my channel look at silver as a store of wealth, but also they see the potential that moonshot, or we see it get up to $50 again. A lot of folks would probably at that time look to convert a portion of their silver stack. I personally will keep my silver eagles and look to trade my foreign silver, my silver bars, lower premium silver into gold at that time to capture and take advantage of that tightening gold to silver ratio at that moment when silver does go parabolic. But as you said, what goes up must come down, and it probably will create a lot of sellers if we see a very strong run up in the price of silver. And so I can see why you would be more invested on the stock side of silver so that you can make a quick trade, vice having a lot of physical that you would have to move in that environment. So thank you for that insight. I do have one final question for you here.
Please.
And that is, I know that you're diversified across physical gold and silver as well as in the mining and royalty companies. Can you share any tips for us on how to pick potentially winning mining stock or royalty companies? And if you have a preference for either those traditional, junior miners that are out there drilling and discovering, or more so on the financing side of the operation? Anything you could share would be great for the audience.
Yeah, I think most juniors right now, or in the past 10 years, have done more drilling than discovering. But in general, what I'm saying is they've had a very lousy 10 years. First of all, when we look at opportunities in this space, look at what happened 2 weeks ago as something that you need to remember. If you go to Wealth Research Group /COMEX, that's a special report that I created for this interview, and it's about what happened 2 weeks ago with the flash crash right after the jobs market. So the jobs market came in at 943,000 jobs. Phenomenal jobs report. It was on a Friday. Gold just tanked because algorithms were programmed to sell gold if the job reports comes up, above 900,000 jobs. There's no human intervention there. It's a set program. The thing is that once that sell-off started, there are other algorithms that are just programmed to sell at 1750, and so they triggered, and it was a flash crash. And it's what you need to know on the other side of it is, man, this was a lot of selling that was unjust. It literally was just algorithm. So on Monday, the following Monday after the Friday, on our newsletter, on a free newsletter, I said, look, guys, this is really an interesting setup. The gold was like a little bit below 1,700. Look at gold right now. If you need
it's $100 up, and it's been less than a week.
Yes,
or about a week.
So, yeah, and so that is something that I think people should also consider, those types of opportunities. Okay, now when you look at like the mining space or the mining sector, there are different types of companies. The best companies over time have proven to be these royalty companies. It's fine that you kind of mentioned it. Most people don't ask me about those, but those are the companies that have done the best. If you look at if research the best gold royalty companies or the biggest ones, you will see that they have beaten the S&P 500. They've beaten the NASDAQ over a 10-year period. These are really amazing companies because they're not really mining companies. They're built in such a way that shields them from the downside and helps them on the upside. They're amazing companies that are worth billions of dollars, tens of billions of dollars, and have like 20 employees. Yeah. These are unbelievable business structures. Okay, so you've got those. Then you have operating miners, companies that operate mines. What they need to do is their management gets up in the morning and thinks two things. How do I lower the cost of this of production? How do I find more gold under this mine? So how do I expand the mine life? Those are the two things that they can control. They can't control the price of gold. And so when the price rises, their costs, if they are able to lower their cost, they become more profitable. Those stocks tend to do very well. Okay, then you have the developers. The developers are trying to get a project that's still not in production, but has an economical amount of a certain commodity or a basket of commodities in the ground, and they have developed and engineered a plan on how to get it out of the ground for a very low price, a profitable price. And so those are the third type of companies. Well, now there's a few catalysts on the way there. Every company goes through these catalysts, and every time they hit that catalyst, it's a de-risking event. If that de-risking event is not priced into the stock, then you get a really good chance of a good rally. I'll give you just an example. If a company is able to approve their mine, to permit it with the indigenous people or the First Nations, and you believe that that is not priced into the market cap of the company, if they actually announce that, then there's going to be a 20, 30, 40, 50% rally off of that news. So these companies move with news because they need to hit these milestones. Obviously, if gold is rising or silver or whatever they have in the ground, if the price is rising, then their project becomes more valuable because they have a set amount of ounces and now they're worth more.
Right.
And then the last one on that value chain is the explorers or the ones that do a lot of the drilling. The risk reward or the reward is the highest there. The risk is also the highest there. So with those companies, I would, if you're looking at them, I would say to pick the best ones, look at companies that are run by people that have actually succeeded in the past. If you see companies that have geologists that have discovered, drilled and discovered minerals that actually developed into mines later, it's a great sign. If there's the next level, if those geologists actually are in the same region where they found that original one, that helps you more, right? Because now you know this is an expert on that area. And so this is the second one. The third one is if they come from a big company. If they've done geological work for one of the majors, like a Barrick or a Newmont, etc., or a BHP or Rio Tinto, then that's amazing because now you've got somebody that came in from the world of large market caps that don't do any drilling, but look at thousands of properties over the world and try to buy them out. So you've got somebody who's looked at so many other projects. If he picked this one and chose to give up a big salary with a company that pays him probably 25 to 30 a month to be on that team, and he went and said, I'll give up a lot of the salaries. I want shares in this company. And if they are able to drill and succeed, then I will make a lot of money. Then that's a really good sign because he's giving up a lot to be there. The junior mining sector is not a sector with large salaries. It's a sector with large compensation. So lots of options or stocks, because that's what those companies can give their team members. So that's the second thing. The third thing, or just because I know you want to recap this, but look, if you call these companies, there's somebody to talk to over there on the other side of the line. Ask him questions, okay?
Yeah, I never thought of that.
How much stock do you own? Who owns the majority of the stock here? How do you raise money? What do you think about your property compared to this property? What's your plan for the winter? If the property, how's the government like? How do you, dealing with all the regulators in your jurisdiction? Ask questions. There's 1,800 mining companies trading on the various exchanges. There's time. You can do your homework. It's not a burning issue that you have to literally do it today. In fact, we authored the most comprehensive report about all these types of companies online that I know of. If you hit wealthresearchgroup.com/gold playbook, you can download like a 2-part serious report about all of this. And I think that's good with some coffee or tea. You sit, take your time. You'll learn a lot about these things that took me, over a decade to put together. And I think doing that kind of a research is great for you. You'll learn a lot speaking with companies. And most of the time, you'll actually be speaking with the chairman or the CEO, the president. It's not like these are companies with hundreds of employees.
Yeah, that's terrific. And Lior, I will definitely link all of the links to the Wealth Research Group down in the video description section. So important to note then, you want to follow those winning football coaches, so to speak. You take a football coach and you move them from one program to another program, and that program become successful, clearly you have an ingredient for success. And that is the same when it comes to the mining industry. You're looking for that management team, the scientific team that has a track record of success in either with that company or that region. And that is a great way to identify those winners. And I also thought it was very interesting that many of the investors in this segment are more or less putting their success on their ability to find and deliver. And that's where the bonuses, the restricted stock units, the profit sharing, I imagine, options, where that comes in. And that's how so these guys are definitely trying hard here to keep their costs low, to deliver the product, and then obviously take advantage of gold's higher price today. So thank you very much for this wonderful interview. I learned so much. I'd be grateful to have you back in the future, because I would really like to learn more about how a rising interest rate environment is going to impact gold and silver going forward, especially with tapering off being discussed by the Fed. And as we stop buying those assets each month, what sort of an impact that's going to have on interest rates, and of course how that's all going to play on the value of gold and silver. So thank you very much for your time. I appreciate it.
I really enjoyed it.
All right. Well, thank you again, guys. This is Lior Gantz, the founder of wealthresearchgroup.com. Hopefully you enjoyed today's interview. I will actually section it off. I'll mention that in the beginning of the video. If you're here at the end, thank you all very much. Hopefully you learned as much as we did. Have a great day, and we'll see you again soon on another precious metals focused video.